So, house hacking isn't about ambition anymore. It exists because in today's housing market, waiting for rates to drop or saving longer or trying to buy the safe way can actually put me further behind.
Hey, and that's the part nobody tells buyers. Because the system changed. And if I don't change how I buy, I don't just miss opportunities, I miss time. All right, let me say something uncomfortable right out of the gate. If I'm doing everything right, good job, solid income, saving money, and buying a home still feels completely out of reach, that's not a me problem. The system changed.
Yeah, and the housing system I was taught to trust was built for a different economy, a different housing market, and a different way people used money. That system, it just doesn't exist anymore.
So if I'm still trying to buy a home the same way my parents did, I'm not behind. I'm just using a playbook that's expired.
Yeah, and what we're seeing right now isn't a trend or a phase. House hacking isn't optional anymore. It's what happens when the old mortgage math breaks the buyers and they have to adapt just to get in the door.
And most buyers don't realize how far off the old advice actually is. So now that we've said that quiet part out loud, let's talk about the biggest misconnection with buying a home in 2026.
Your fault. You're like a baby, making noise, don't know what to do.
Because when people say, explain this to me like I'm 5, what they're really asking is, why does buying a home feel almost impossible, even when you're doing everything right?
Yeah, well, first, you can't say modern home buyer and traditional lifestyle in the same sentence. That's no longer reality. And honestly, that's the biggest lie being sold right now. The traditional family used to look like this: a picket fence, a single wage earner household, and a brown station wagon parked outside. No seatbelts, no distractions, and no competing priorities. That model, it just doesn't exist anymore.
Today's modern family is living in a completely different world. And it's important to say this clearly. It's not because they're irresponsible. It's not because they don't care. They care, just about different things.
Yeah, modern households aren't only thinking about their future, they're balancing lifestyle, travel, experiences, technology, flexibility, the quality of life right now. And that shift, it didn't just happen by accident. I mean, those expectations weren't simply a part of everyday life for previous generations.
Tommy was the scientist, not me. He was the one who wanted to get shot light years out in space to find the answers.
Are we there yet? Yeah, we're there, sunshine.
Hey, when we think back to the homes many of us remember growing up in, our grandparents' houses, the difference is obvious. Small footprint, small living room, small kitchens, even smaller bedrooms. A home was a place to sleep, eat some dinner, and maybe gather around a single television at night.
Life didn't happen inside those homes, it happened outside of them. Front yards, backyards, the trees, space to move. Homes were functional, not immersive.
Now look at today's home. Kitchens are open, expansive, and designed like you're on the set of a Food Network show. Living rooms are massive, sometimes the size of what used to be an entire house. And once you create that kind of space, it demands to be filled. Multiple couches, entertainment system, game tables. The space dictates the lifestyle.
Yeah, and bedrooms, they followed the same evolution. What used to be a place just to sleep is now a personal retreat. Large square footage, private bathrooms, spa-like finishes. The home isn't just shelter anymore, it's an experience.
You're not in Kansas anymore. You're on Pandora, ladies and gentlemen. Respect that fact.
And while homes got bigger on the inside, outdoor life quietly disappeared. Where older homes had usable land, yards meant for living, many modern properties now offer a few feet of turf and a retaining wall and a couple of those decorative trees. Outdoor space became visual, not functional.
This didn't happen by accident. Life moved indoors. Homes became a personal oasis designed to pull people away from the world and help them escape it. And that expectation is now baked into the cost.
Hey, and at the same time, housing costs have outpaced income. In many markets, buying a home now requires 40 to 50% of your net household income. At that level, the problem isn't desire, it's structure.
Yeah, so instead of abandoning home ownership, buyers are changing how home ownership works. We're seeing the return of generational cohabitation.
Why did you come to us?
Came to learn.
We have tried to teach others guide people. It is hard to fill a cup which is already full.
My cup is empty.
Parents living with adult children, grandparents moving back into the household, and we're even seeing friends team up with other friends to house hack, sharing space not just to afford a home, but to maintain their lifestyle while still contributing to their future well-being. This used to be normal, but it disappeared during a period of abundance. Now it's returning out of necessity. And in many ways, it's rebuilding connection and cooperation across generational and relationship goals.
Homes are no longer evaluated only as places to live. They're evaluated as systems. Bedrooms matter. Layouts matter. Separate spaces matter. Ownership is being redesigned to support multiple incomes, multiple generations, and a modern lifestyle all at once.
Yeah, and that redesign has a name. It's called house hacking, not as a trend, not as a shortcut, but as the most practical way for modern families to maintain their lifestyle while still building financial stability and long-term wealth management through homeownership.
And that's what today's episode examines. Why is this shift happening? Why house hacking actually works? And why, for buyers who refuse to sacrifice their lifestyle, it's quickly becoming the only viable path forward.
Yeah, but fair warning here. If you're stuck on how ownership used to work, you're probably not going to like what you're going to hear today, because the market, it's already moved on.
The time of great sorrow was ending. The Rook Makto was no longer needed.
Beginning in the 1950s and continuing through each generation that followed, there's a broadly accepted roadmap for what adulthood and home ownership was supposed to look like. The details evolved slightly over time, but the foundation stayed the same. And that system was designed to support it.
That's right. And in the 1950s, buying a home was a standardized milestone. There was a sequence. You finished school, you got a job, you found a potential spouse, you made them your spouse, you made babies, you bought a house, and you made memories. Cue the fairy tale soundtrack. That was the order for decades, and that mostly worked.
As generations moved forward, the lifestyle expanded. Dual incomes became more common, homes got bigger, expectations shift. But the assumption remained the same, that housing systems would still meet the people where they were.
Yeah, but by the time we reach the most recent generation of buyers, that assumption, it no longer holds. Home ownership is no longer a milestone waiting at the end of a prediction and a predictable path. It's a high barrier financial decision that requires planning, precision, and often multiple sources of income.
The biggest shift is the relationship between income and home prices. In the 1950s, the median home price was roughly 2 times the average annual household income. That ratio mattered because it allowed people to buy early and stabilize their lives over time. Today, that relationship no longer lines up.
In 2026, buyers often needed an income of around $112,000 per year to afford a medium-priced home. That medium-priced home is now a little over $400,000, which means today's household must earn roughly 4 times what previous generations needed to walk into with opportunity. Before lifestyle preferences or choices enter the conversation, the math already breaks. And that's before we even add the modern lifestyle adder, costs that simply did not exist before the previous generations.
Earlier generations weren't budgeting for constant connectivity, subscription-based living, on-demand transportation, or experience-driven spending as a baseline. Those weren't even lifestyle choices. They weren't even options.
No. So, when we compare affordability across generations, we're not comparing equal households. They're just not even the same. Today's modern family is carrying an entirely different cost structure on top of housing. That's fundamentally changing the math.
Put that into perspective. In the mid-1950s, a new home cost about $12,000. Today, median home prices in many markets exceed $400,000, with coastal regions pushing far beyond that. That's not inflation alone. That's a fundamentally different buy-in.
Yeah, now layer in financing. In 1960s, the average mortgage rate was around 5.1%. In early 2026, rates are sitting closer to 6.2% after briefly moving around 7% the year before. So on paper, those rates don't look dramatically different, but in practice, the payments impact is far heavier.
Down payments tell the same story. The idea of a 20% down came from post-Depression lending standards. But many buyers in the 1950s used FHA or VA loans with very low down payments, sometimes just a few $100s. Today, first-time homebuyers still put less than 20% down, not because they're reckless, but because saving a full down payment often means accumulating six figures in cash. In high-cost states, that number can exceed $150,000.
Yeah, then there's competition. In the 1950s, the primary buyers were people in their 20s and 30s. By 2025 and 2026, roughly 42% of buyers are baby boomers, many purchasing with cash. And that changes the entire playing field for buyers relying on financing.
And the product itself has changed. The average home in the 1950s was under 1,000 square feet. Today, the average home exceeds 2,400 square feet, with open layouts, multiple bathrooms, and integrated technology. Homes just aren't shelter anymore. They're complex systems, and systems cost more to build, insure, and maintain.
Yeah, even the buying process reflects the evolution. In the 1950s, local newspapers were the deal, personal bank relationships, paper contracts. Whereas in 2026, it's all about AI-driven search tools, 3D virtual tours, digital disclosures with automated underwriting. The process is faster, but far less forgiving.
So when people ask, why are buyers behaving differently today? The answer isn't attitude, it's environment. Higher prices, more competition, later entry ages, and a system that demands precision.
Yeah, when a milestone becomes this complex, people don't walk away from it, they adapt. They stop viewing homes as static purchases and start viewing them as structures that must support themselves financially.
So segment one comes down to this. Homeownership didn't just get harder, it became different. And when systems change, behavior follows.
Yeah, which leads directly into the next question. If the traditional ownership model no longer fits the math, what does the new model actually look like?
So now that we understand why the old ownership model no longer fits the math, the next question, it's obvious. If buyers can't change prices, and they can't change rates, and they can't rewind time, what are they actually doing to make homeownership work?
Yeah, they're not reinventing real estate and they're rethinking how space is used. House hacking today isn't about ambition, it's about feasibility. And the way it's being executed in 2026 looks very different than it did a decade ago. Just like this week's theme is Avatar, the move to Pandora wasn't about curiosity, it was necessity because the old world no longer worked.
That's exactly where today's homebuyer is. The old rules don't work anymore. One income, one household, one paycheck carrying the entire payment. That's model, it's collapsed. So the new set of rules had to apply.
House hacking exists as a structural response to a market where housing costs routinely consume 40 to 50% of take-home pay if no offset exists. House hacking is how buyers close that gap. The Brady Bunch vision of family economics is gone. Today's household is a system, multiple contributors, shared responsibility, and one goal: maintain lifestyle and build a financial future.
The most common execution is simple. The roommate subsidy. Buyers purchase a standard 3 or 4 bedroom home and treat extra bedrooms as income. Not forever, not for fun, but to make the payments survivable.
That's right. And in real numbers, 1 or 2 roommates often contribute $800 to $1,500 each per month. That can offset 25 to 45% of the total housing costs. That's not a side hustle. That is survival math.
And welcome to the modern way of life. This is house hacking, whether you're ready for it or not. It's a shift that needs to be talked about, especially for buyers under 40 who are still building their lives.
And it's not just young buyers. We're seeing established friends, sometimes even families, come together under one roof, not out of desperation, but to protect lifestyle while still securing a piece of the American dream. It's just under new rules inside a new system.
The second major execution is ADUs. Backyard units, garage conversions, basement apartments.
That's right. An ADU, it can generate $1,200 to $2,500 per month in many markets. That turns a home from a single income burden into multiple income asset. It reduces risk, it creates flexibility, it makes homeownership sustainable.
We're also seeing shared ownership increase. Friends, siblings, partners buying together.
Yeah, because one income doesn't qualify comfortably, but two or three, it often does. And that home becomes a shared platform. And for many buyers, this is the only path into homeownership at all.
Across every version of house hacking, one principle still stays constant. Buyers are no longer assuming their paychecks alone will carry the home. They're buying properties that they can allow them to participate in their own payment.
Most buyers aim for one benchmark: rental income covering 30 to 50% of total housing costs. That's the line where lifestyle stays intact, stress drops, ownership works, and it all makes sense.
The trade-offs are real. Less privacy, more responsibility. But for many buyers, the alternative isn't simplicity, it's exclusion.
Yeah, house hacking isn't about gaming the system, not at all. It's about surviving inside a system that's already changed. When the rules change, you adapt.
Which brings us to the next question. If this is how people are getting in, then what are the risks no one is talking about?
Yeah, that's where we're going to head next, and it's really interesting what we're about to say.
So now that we've walked through why house hacking exists and how people are using it to get into the market, we have to talk about the part that almost nobody advertises, the risks. Because house hacking works, but only if you understand what you're signing up for.
Yeah, and this is where intention matters. Just like Avatar, Jake Scully, he didn't sign up to find his purpose. He signed up to replace his brother on Pandora as a scientist with military background, having no real idea what he was stepping into.
But the environment changed him. The world he thought he was there to exploit revealed something in him that even he didn't see yet. Once he found his why, his entire path changed.
Yeah, home ownership works the same way. If you don't know your why, you're just reacting. You're surviving month to month without direction and without an end goal. And survival alone is never a great way to build a life.
That's why homeownership still matters, even in today's modern world, not just because traditional, not because it's nostalgic, but because it gives you a foundation, a place to return to your why, a structure that supports direction, not just shelter. Everyone needs a why in life, no matter how modern their thinking is.
Yeah, now let's get practical again. The first real world risk, it's privacy. When you house hack, your home stops being your sanctuary. You're sharing space, you're sharing schedules, and you're sharing responsibility. You're not just a homeowner anymore. You're a landlord, a roommate, and sometimes you're a referee all at once.
Next is legal and zoning risks. Hey, cities are catching up. Short-term rentals are being restricted. ADUs are being regulated. Occupancy rules, they're tightening. What works today may not work the same 5 years from now. House hacking requires attention, not autopilot.
Then there's maintenance. More people means more wear and tear. HVAC systems, plumbing, appliances, roofs. Repairs are more expensive than ever now. And if your house hacking income barely covers the payment but can't absorb repairs, stress shows up really fast.
Another overlooked risk is its relationship strain. Friends buying together, families living together, multiple adults under one roof. Money changes the dynamics. Expectations must be clear. An exit plan must be written. And the boundaries, they have to exist. House hacking fails most often when communication doesn't scale with complexity.
That's right. And I mean, let's face it, there's also burnout. When your home produces income, it never fully turns off. There's always something to manage, something to fix, and something to decide. That's why this strategy works best when it's understood as a phase, not as a forever lifestyle.
Which brings us to the most important non-negotiable, exit strategy. Every successful house hack starts with one. Do roommates eventually leave? Does the ADU become a long-term rental income? Do you refinance and restructure? Do you sell and roll the equity forward? If you don't know how it ends, you don't control the strategy.
Yeah, and house hacking, it's powerful, but it's not passive. It rewards people who plan, who adapt, and who stay disciplined. And it punishes people who drift without purpose.
So the takeaway today isn't everyone should house hack. It's this. The housing system changed. People adapted. And the ones who did this well. And they're not chasing trends. They're building leverage inside a new reality with intention.
Yeah, and for some, house hacking, it's a bridge. For others, it becomes the foundation. But for most buyers in 2026, it's the difference between waiting indefinitely or actually getting into the game.
You are not in Kansas anymore. You are on Pandora, ladies and gentlemen. Respect that fact every second of every day. If there is a hell, you might want to go there for some R&R after a tour on Pandora. Out there beyond that fence, every living thing that crawls, flies, or squats in the mud wants to kill you and eat your eyes for jujubes.
Now, let's get to our ever-popular Rate Tracker segment, where we go over year-to-date rates month by month, and we see how we're doing with our beginning-of-the-year predictions. As of today, the 30-year fixed mortgage rate is sitting around 6.15%, with the 10-year Treasury yield at about 4.19%. Before anyone jumps to conclusion, this is exactly what we've been saying all year. The rate environment is about ranges, not miracles. So let's rewind to where we started.
Yeah, so back in January, we told you not to expect a straight line move lower. We said volatility would remain elevated and rates would move sideways with sharp reactions to the data. And that's exactly what happened. January, the 30-year fixed the direction. It was slightly up. It was choppy. And why? Because stronger than expected economic data. Inflation was proving stickier than markets hoped for. And the bond markets, they were repricing the timing of the rate cuts. January wasn't a breakdown. It was a market pumping the brakes on the optimism. Now let's talk about February, where we are right now. February 30-year fixed, just like Manly, you said, at 6.15, with the 10-year Treasury sitting at 4.19. That direction, it's stabilizing. Inflation is no longer accelerating and growth is slowing, but not collapsing. The markets are settling into a higher for longer reality. This isn't panic. This is digestion. So let's talk about year-end projections, because this is where we planted our flags. My call is the same the beginning of the year. A 30-year fix was going to land between 4.5% and 5.25% range by year's end if inflation continues to cool and policy begins to ease. Now, that was and still is my optimistic path. What about you, Manly?
Well, I'm questioning where this if portion came into the matter, because originally that wasn't in place. So I like how you're sort of like covering your butt there a little bit. But my projection was really more conservative from the get-go. I said that 30-year fix likely finishes the year in the 5.25 to 5.5 range, not because rates can't move lower, but because the cycle takes time to unwind. Sticky inflation, labor strength, and cautious policy, they all matter here.
Yeah, and the truth is only time will tell where both of us actually land and what actually happens, especially with potential changes at the Fed.
Yeah, the one wild card we can't ignore is the potential new Fed chair. Leadership matters. Tone and policy direction move markets long before the official rate cut happens.
The name being discussed most is Kevin Warsh. He served on the Fed's Board of Governors from 2006 to 2011, which means he was on the inside of the system during the financial crisis and early balance sheet expansion. That experience, it definitely matters.
Warsh, historically viewed as an inflation hawk, but more recently has showed openness to lower rate growth supportive policies if conditions justify it.
Yeah, and this comes after tension between the White House and Jerome Powell over the pace of the rate cuts. A leadership change doesn't just change headlines, it changes expectations.
And expectations move bond yields. If leadership becomes more open to balance sheet expansion or liquidity support, mortgage rates can respond before any official policy shift actually takes place.
Yeah, which is why our projections, they're still standing, but also why flexibility matters.
And that's the real takeaway. Rates aren't broken. They're behaving normally again, which means waiting for the perfect rate is no longer a strategy.
In this environment, the buyers who win aren't trying to time the rate, they're structuring the payment.
And that brings us full circle to today's episode. When rates move sideways and affordability stays tight, strategy beats timing every time.
Yeah, that's your rate tracker. We'll keep watching the data, the spreads, and the direction, and we'll keep calling it straight.
All right, listen up. This isn't story time. This is reality. I'm Ranger Rick today. Short-tempered, no patience, jarhead to the core. And we're breaking down buzzwords. No fluff, no feelings. Let's move. First up today, we are going to be talking about house hacking.
Well, I mean, where do I go here? House hacking, it's using the home you live in to offset the cost of owning it, right? Roommates, rentals, extra units. It matters because of how buyers survive when the payment alone no longer works.
Right. Manly, ADUs, what are they?
Accessory dwelling units. They're detached units, garage conversions, basement apartments, designed to turn a single-family home into a multi-income property. They matter because income changes the math.
Up next, Anthony, tell us about multi-gen homes. Are they a trend or are they a necessity?
I mean, 2026, they're definitely a necessity. Multiple generations, they're sharing one property, to support the lifestyle and the affordability and, more importantly, stability. This used to be normal. It wasn't for a while, but now it's coming back because the system demands it.
Manly, expanding the balance sheet. Please translate.
Hey, Ryan, excuse me, whatever your name is, Ranger Rick, that's when the Fed injects liquidity by buying assets like treasuries or MBS, mortgage-backed securities. More liquidity usually means lower yields and eventually relief for mortgage rates, bringing the rates down.
Anthony, amortization schedules. Why do people ignore this?
Because it's boring, right? And expensive to ignore. It shows how much interest you're actually paying over time and why early strategy matters more than the rate headlines.
All right, that's enough education for one mission. And remember, you are not in Kansas anymore. Or in this case, we're in Kauai in Wisconsin. Different terrain, different rules. Adapt or get left behind.
All right, guys, this is the part where we usually talk about, liking and subscribing. But really, for me, I just wanted to thank you all, to all our subscribers and our listeners and our viewers. Thank you from the bottom of my heart. Thank you to Anthony for participating in this with me. It's super meaningful to me, and I'm glad that everybody else is enjoying it. Really looking for someone to give us some really good commentary about topics and that kind of stuff, just because we are trying to help you break through all the nonsense and the weeds that go out there in the mortgage industry, trying to educate you, one video at a time here. And we hope you enjoyed watching it, listening to it as much as we enjoy putting this together.
Yeah, I mean, it's all about education, right? And so if people are going to be going into this endeavor of home ownership, the biggest thing they need is information to build that confidence, because a confident buyer is an educated buyer and it's a buyer making right decisions. So that's what we're about, instilling confidence and one buyer at a time.
Yes, sir. Great stuff. Hey, Anthony, I got an interesting fact for you. You ready?
Oh. Yeah, you're twisting it. Usually I ask you an interesting fact. So yeah.
Yep, here we go. Hey, and this one's actually a big one.
Okay.
Here we go. Interesting fact. When you become a grandpa, you don't get older, you get upgraded. Suddenly your stories matter more, your advice sounds wiser, and somehow you're allowed to spoil a kid and call it tradition.
I take it you're well versed in that.
But seriously, becoming a grandpa means something real. It means you build something that keeps you going without having to push it anymore. That's legacy. So congratulations, Anthony. Welcome to the Grandfather Club. That title you earned, and you should be proud of it.
I appreciate that, man. Yep. I became a grandpa 48 hours ago, so healthy baby boy. And yeah, we're going to spoil the crap out of him, and hopefully he becomes a homeowner within the next 18 years.
What does it actually mean to be spoiled in Kauai terms?
Spoiled in Kauai terms is, making sure you get your daily fishing, because if you don't go out and fish, life doesn't feel right. Making sure that we don't have shoes on 24 hours a day. We got to feel the ground. Got to be grounded, right? And knowing that your chores have to do with outdoor duties. You're not inside scrubbing toilets. You're outside scrubbing stalls in the form of ponies and other livestock. So it's a different world for sure.
Awesome. Well, congratulations. Super proud to be part of your new family that's growing by the minute. That's amazing. And congratulations to your daughter and your son-in-law and your wife, who's now the new best grandma in the world. Appreciate all that.
Thanks, man. Appreciate it. I'm glad to be part of the club.
Have a great one, you guys. Thanks for tuning in.
Girl from the heart of Wisconsin to the waves of Hawaii. Manly and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know, with a little soul and a little homegrown flow. It's the Mortgage 101 podcast, where real talk meets home at last. Manly's got that Midwest soul. Anthony brings that island roll. When the market swings and you don't go fast, tune in, the Mortgage 101.